What's going on, everybody? This is Chris from Project Option, and in this video we're going to talk about the top 3 credit spread option strategies for income. So we're going to briefly discuss each of the 3 strategies. I'm going to show you how they're set up, and then I'm going to show you some real trade examples so that you can see how each of the strategies performs relative to changes in the stock price over time. So let's get started. So first and foremost, credit spreads are very common among income traders because they can profit in more than one way. Now that makes them very high probability trades. So let's go ahead and talk about the primary ways credit spreads can profit. Generally speaking, credit spread strategies can profit from the following. So they can profit from favorable changes in the stock price. So that means if you put on a bullish credit spread and the stock price increases, you can make money that way. You can also make money if there are small, unfavorable changes in the stock price. Now that means if you place a bullish credit spread strategy, you can still make money even if the stock price decreases, but it can only decrease a certain amount. It can't decrease substantially. Now the third way you can profit from credit spread strategies is from the passing of time. Now that's because option prices decay as time passes, and as a credit spread trader, you collect premium when you put on the strategy, and as that premium decreases in value, you get profits from that. And the fourth and final way you can profit is from decreases in implied volatility. Now a decrease in implied volatility just means that the stock's option prices are decreasing. And with credit spreads, since you are net short options, which means you've sold options, you want the option prices to decrease. So what exactly is a credit spread? Well, a credit spread is an option strategy that collects premium when the trade is entered. Now, in other words, the options that are sold bring in more premium than what's paid out for the options that are purchased. So let's go ahead and look at a real example. So here we're looking at a couple put options on a particular stock, and we just selected a couple strike prices to use for this example. So in this case, if we sell the 142 put for $5.96 and buy the 135 put for $2.56, we collect a credit. Now that's because we collect $5.96 from selling the 142 put, and we pay out $2.56 from purchasing the 135 put. Now that means we collect a net credit of $3.40 or $340 in actual premium. So a credit spread is just a strategy that collects premium when you enter it, which means the options you sell are more expensive than the options you buy. Alright, so now that we've talked about the basics, let's get to the fun stuff and talk about the top 3 credit spread option strategies. So the first strategy on our list is the put credit spread, which is constructed by selling a put option and then buying another put option at a lower strike price. Now, put options at lower and lower strike prices are less expensive, and therefore, by purchasing a put option at a lower strike price than the put option you sold, you will collect a credit. Now, both options should be in the same expiration cycle and have the same quantity. So if you sell 3 puts, you should buy 3 puts at a lower strike price to complete your put credit spread. So here are the key characteristics of the put credit spread strategy. Now, a put credit spread has a bullish directional bias, which means the strategy profits from stock price increases. Now, the strategy also has positive exposure to time decay, which means the strategy profits from the passing of time, barring any unfavorable stock price movements. Now, the maximum profit potential that you can make is the credit received times 100, and the maximum loss potential is the width of your put spread minus the credit received times 100. And lastly, the break-even price of the strategy is the strike price of the put that you sell minus the credit received. So by collecting a credit, you actually have room to move on the downside, and the stock price can actually be below your short put strike at expiration, and you can still make money. So let's get into an example. So for example, if we sell a put option with a strike price of 100 for $5, and then buy a put option with a strike price of 90 for $2.50, we collect a credit of $2.50 since we're collecting $5 and paying out $2.50. Now that means our maximum profit potential in this example is $250, which is the $2.50 credit times 100, and the maximum loss potential is $750 because we have a $10 wide put spread and we collected $2.50. So $10 minus $2.50 times 100 is $750. Now our break-even price is the short put strike price of 100 minus the $2.50 credit, which comes out to $97.50. So that means that if the stock price is right at $97.50 at expiration, we won't make or lose any money. Now if the stock price is above $97.50 at expiration, we will make money on this strategy. So the real put spread example we're going to look at is to sell the 700 put and buy the 640 put for a net credit of $18.05. Now this means our maximum profit potential is $1,805, which is the net credit times 100, and the maximum loss is the width of the spread minus $18.05 times 100, which comes out to $4,195. Now that maximum loss potential is only realized if the stock price drops substantially. Now our break-even price in this case is $681.95, and that gives us some downside room to move. So let's take a look at the strategy's performance as the stock price is changing over time. So on the top part of this graph, we're looking at the changes in the stock price relative to the strike prices of our put spread. Now, we can also see that our break-even price is $681.95, and that's because we collected a net credit of $18.05 from selling the 700 640 put spread. So our break-even price is $700 minus $18.05, which is $681.95. Now on the bottom part of this graph, we're looking at the profit and loss of the spread as time passes. So as we can see here, anytime the stock price drops, we can see that it is negatively affecting our profit and loss since we sold the put spread. And anytime the stock price increases, that benefits our P&L because as the stock price increases, put spreads lose value. And since we sold the put spread, we want its price to decrease. Now at expiration, we can see the stock price is well above our put spread, and therefore the put spread expires worthless. Now since we collected a net credit of $18.05, the profit and loss at expiration is plus $1,805. So we make $1,805 from selling this spread because the stock price is completely above our put spread at expiration. So this is a strategy you would use when you are bullish on a stock, but you also want to be able to profit if that stock price remains flat or even decreases slightly. Now the second strategy on our list is the call credit spread, which is constructed by selling a call option and buying another call option at a higher strike price. Now both options should be in the same expiration cycle and have the same quantity. So for example, if you sell 5 call options, you should buy another 5 call options at a higher strike price. Now you'll collect a credit for this strategy because call options at higher strike prices are cheaper than call options at lower strike prices. So the call option that you sell will bring in more premium than you pay out for the call option that you buy. So here are the key characteristics of the call credit spread strategy. The directional bias is bearish because call credit spreads profit from stock price decreases. Now that's because call options decrease in value as the stock price falls, and therefore your call credit spread will decrease in value as the stock price falls. Now the exposure to time decay is positive, which means the call credit spread profits from the passing of time. Now that's because option prices decrease in value as time passes, which leads to profits for your call credit spread as long as the stock price doesn't increase substantially. Now the maximum profit potential is the credit received times 100, and the maximum loss potential is the width of your call spread minus the credit received times 100. Now the break-even price is the strike price of the call that you sell plus the credit received. So let's go ahead and take a look at an example. So here is an example of a call credit spread. So let's say you think a stock price is going to remain below $125 through the expiration of your credit spread. To play that, you could sell the 125 call for $3.50 and then buy the 135 call for 50 cents. Now your net credit in this case will be $3 since you collect $3.50 from selling the 125 call and you pay out 50 cents from buying the 135 call. Now this means that our maximum profit potential is $300 at expiration, And that's because we collected a $3 credit, and the option multiplier of standard equities is 100, which means your $3 credit times 100 represents $300 in actual dollar terms. Now the maximum loss of this spread is the $10 strike width minus the $3 credit times 100, which comes out to $700. So that maximum loss will occur if the stock price rises substantially and is above $135 at expiration. Now the break-even price is the short call strike price of $125 plus the $3 credit, which comes out to $128. So if the stock price is right at $128 at expiration, you won't make or lose any money. And if the stock price is below your break-even price of $128, you will make money at expiration. So as you can see, that credit you received actually allows the stock price to be above the call that you sell at expiration. So let's look at a real call spread example with real option data. So the trade that we're going to look at is to sell the 120 call and buy the 125 call for a net credit of $1.93. Now the actual stock does not matter because the mechanics will be the same no matter what stock you choose. So since we collected a net credit of $1.93, our maximum profit potential is $193. That's because we take the net credit of $1.93, multiply it by the standard option contract multiplier of 100, and we get $193. Now the maximum loss potential in this case is $307 since we sold a $5 wide call spread and we collected $1.93. So the maximum price that this spread could trade for is $5, and since we collected $1.93 for it, $5 minus $1.93 times 100 comes out to $307. Now our break-even price for this spread is $121.93. Now that's calculated by taking the call strike that we sold, which is $120, and then adding the credit of $1.93 to that. So if the stock price is below $121.93 at expiration, the strategy will make money. So let's go ahead and take a look at this strategy's performance. So just like before, the top part of this graph shows the changes in the stock price relative to our call strike prices and break-even price. So as we can see here, the stock price is trading just below 120, and we sell the 120-125 call spread for a net credit of $1.93. Now this means our break-even price is $121.93, and that means that our strategy will be profitable if the stock price is below $121.93 at expiration. Now on the bottom part of the graph, we're looking at the profit and loss of this particular spread as time passes and the stock price changes. So in this example, we can see that the stock price starts to increase right off the bat, and that leads to small losses for our credit spread. So that happens because if the stock price starts to increase right after you sell a call spread, that call spread is going to increase in value, and that's not going to be good for you because when you sell a spread, you want its price to decrease. Now in this case, we can see that the stock price actually started to sell off and was below our short call spread as time passed. Now as we can see, as the stock price is below our call spread's break-even price and time passes, we can see that starts to generate profits for us because the call spread starts to lose value as time passes. Now that's that positive exposure to time decay that we talked about before. Now at expiration, we can see that the stock price is right around $113, and that means that our short call spread that we sold expires completely worthless. Now since we sold it for a net credit of $1.93, our profit at expiration is $193. Now if the opposite happened and the stock price was above our call strike of $125 at expiration, we would have realized the maximum loss potential of $307. So the call credit spread is a great strategy to use when you are bearish on a stock, so you think its price will decrease, but you also want to profit from a sideways stock price movement or even if the stock price increases slightly. So the third strategy on our list is selling an Iron Condor, which is actually the combination of the first two strategies. So to construct an Iron Condor, you're going to sell a call option and then buy another call option at a higher strike price, and then you're also going to sell a put option and then buy another put at a lower strike price. So an Iron Condor is actually the combination of a put credit spread and a call credit spread. And the benefit of selling an Iron Condor as opposed to just one of those spreads is that you'll collect more premium overall and have higher profit potential. Now, the downside is that you have to have a range-bound stock price to profit over time. And that's because when you sell a call credit spread, you want the stock price to remain below your call spread. And when you sell a put credit spread, you want the stock price to remain above your put spread. So when you combine the two, you want the stock price to remain right in between your spreads. Now, all options should be in the same expiration cycle and have the same quantity. So if you sell 3 call credit spreads, you should also sell 3 put credit spreads. So let's go ahead and take a look at the strategy characteristics of the Iron Condor. So here are the key characteristics of the Iron Condor, and hopefully this sheds some light on why this strategy is so popular. First of all, the directional bias is neutral, which we just discussed. So since you're selling a put credit spread and a call credit spread, you want the stock price to remain in between those spreads, which means your directional bias is neutral. Now that means you profit as the stock remains range bound. Now, like any other credit spread, your exposure to time decay is positive. Now that means you have profits from the passing of time so long as the stock price remains between your credit spreads. So the maximum profit potential is the credit received times 100, and that's because the standard option contract multiplier is 100 since each option represents 100 shares of stock. So if you collect $2, your maximum profit potential is $200. Now your maximum loss potential is the width of the wider spread minus the credit received times 100. So if you sell a $5 wide call credit spread and you sell a $15 wide put credit spread, your maximum loss potential is actually going to be with the put credit spread since you have a much wider put credit spread. Now there are actually 2 break-even prices for the Iron Condor strategy, with the upper break-even price being the call strike price that you sell plus the credit received, and the lower break-even price being the put strike price that you sell minus the credit received. So basically you want the stock price to remain in between your short options, but then you also have that added buffer from that credit that you received. So that credit you receive actually widens your break-even points beyond the strike prices of the options that you sell. So let's go ahead and take a look at an example of an Iron Condor. For this particular Iron Condor example, we are going to sell the 110-115 call credit spread, which means we're going to sell the 110 call and we're going to buy the 115 call. Now we're also going to sell the 90-85 put credit spread, which means we're going to sell the 90 put and we're going to buy the 85 put. Now from selling both of these spreads, we're going to collect a net credit of $2.64. So since we collect a net credit of $2.64, our maximum profit for each Iron Condor that we sell is $264. Now our maximum loss potential is actually the same on both sides since we sold a $5 wide call spread and a $5 wide put spread. So our maximum loss on either side is $236. Now that comes from the $5 strike width on both sides minus the $2.64 credit times 100, which comes out to a maximum loss of $236 for every Iron Condor that we sell. Now our upper break-even price is the short call strike price of 110 plus the $2.64 credit, which comes out to $112.64. And our lower break-even price is the $90 short put strike minus the $2.64 credit, which comes out to $87.36. So this strategy will be profitable at expiration as long as the stock price is in between $87.36 and $112.64. So obviously we have a pretty wide range of profitability there. So let's go ahead and take a look at a real example so that you can see how the Iron Condor performs as the stock price changes over time. The Iron Condor trade that we're going to look at is to sell the 216 put and 230 call, and then we're going to buy the 209 put and the 234 call. So that leaves us with the 216, 209 put credit spread and the 230, 234 call credit spread. Now we're going to collect a net credit of $1.18 per Iron Condor that we sell. Now that means our maximum profit potential is going to be $118 since we collected a net credit of $1.18. And our maximum loss potential is actually going to be $582, and that's going to be if the stock price is below the put spread that we sell at expiration. So since we have a $7 wide put spread and a $4 wide call spread, the maximum loss potential lies with the put spread. So our break-even prices in this case are $231.18 and $207.82. Now that comes from the $230 short call strike price plus the credit received, and the $209 short put strike price minus the credit received. So clearly we have a pretty wide range of profitability. Now let's go ahead and look at the strategy's performance over time. So as we can see here on the top part of the graph, we're looking at the changes in the stock price relative to our call strike prices and put strike prices. And on the bottom part of the graph, we're looking at the profit and loss of our Iron Condor. So as we can see here, the stock price remains right in between our call strike price and put strike price as time passes. And as we can see, the Iron Condor has steady profits as time passes. Now that's because when the stock price remains between your short call and short put strike price as time passes, all of those options are going to continuously decrease in value, and that's from time decay. So as the stock price remains in between your call credit spread and put credit spread as time passes, both of those spreads start to lose value, and since you sold the Iron Condor, you want all of the options in that spread to decrease. So as we can see here, this strategy was actually maximally profitable at expiration because the stock price was in between the short call strike price of $230 and the short put strike price of $216. Now as we can see here, our profit at expiration is $118 since we collected a net credit of $1.18. Now in the very beginning of this trade, you'll notice that the Iron Condor started to lose money. And that's because if you sell an Iron Condor and the stock price starts to trend in one direction towards one of your spreads, that spread that the stock price is moving towards is going to start increasing in value at a faster rate than the opposite side is losing value. So in this case, the stock price starts rising towards that short call spread, which means the call credit spread is actually starting to increase in value faster than the short put spread is decreasing in value. And that leads to an increasing Iron Condor price overall. So when you sell an Iron Condor, you want the stock price to remain between the call spread and put spread that you sell. And if the stock price starts to trend in one direction and does not stop, then you will start to see losses on your strategy. So the Iron Condor strategy is a great strategy to use when you believe a stock price will remain range bound. Now at the end of the day, if the stock price has a substantial move in either direction, selling an Iron Condor will not be a good strategy to have on. But at the end of the day, you have limited loss potential and you have a high probability of making money on that spread because most of the time stocks do not make large movements in either direction. So now that we've talked about the top 3 credit spread option strategies, it's important to note that these are not set and forget trades, and there are better and worse ways to trade them. So if you want to see some research related to these strategies and you want to see historical profit and loss statistics for these strategies, you can go to our website and you can sign up for a free account today, and you'll unlock all of our options trading guides and strategy research. So when you actually sign up and you sign in, you can get to our options trading research database, and there you'll see all of the research that we currently have. Now, this is an ongoing process and we continue to add research on a regular basis, but you can see Iron Condor research and you can see short strangle research and you can see all of the different strategies that are analyzed historically when you sign up for a free account with us. So the link is actually in the description if you'd like to do that. We've covered a ton of content in this video, so let's quickly recap the main concepts. First and foremost, credit spreads are common among income traders as the strategies can profit in more than one way. Now that makes them high probability trades compared to just investing in stocks. Now even further, credit spreads have limited loss potential, so when you're wrong, it's not going to break the bank so long as you've sized the position properly. Now, put credit spreads profit when the stock price increases or remains above the break-even price as time passes, and they lose money when the stock price falls notably. Call credit spreads profit when the stock price falls or remains below the break-even price as time passes, and they lose money when the stock price increases substantially. And lastly, Iron Condors profit when the stock price remains range-bound as time passes, or when implied volatility or option prices decrease. Now, Iron Condors lose money when the stock price moves substantially in either direction. So all three of the credit spread option strategies discussed in this video can profit from the passage of time, favorable stock price movements, or small unfavorable stock price movements, and they can also profit when implied volatility or option prices decrease. This makes credit spreads very high probability trades, and when you're wrong, they have limited loss potential, so if you're sized properly, it's not going to be disastrous. Thank you for watching this video, everybody. I really appreciate you sticking around. If you found this video informative, please go ahead and subscribe to our YouTube channel so that you can get all of our future videos on options trading. Now, if you want to check out some more videos, you can go ahead and click on the video link on the right-hand side.